We are going to talk about the latest changes, or should I say the latest correspondence to Florida retirement system retirees. You're going to love this one. Bottom line question is going to be, how much did the annuity company pay the state to get that kind of promotion? Interesting stuff for our fellow listeners who are part of the Florida retirement system. Also going to be talking about withdrawal strategies. You know, putting money into a 401k, relatively easy. But the problem is, especially with all these changes that have occurred over the course of the past few years, the exit strategy requires an in-depth documentation of how best to take that money out. So we will certainly talk about all of that on the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner and certified financial fiduciary at Nelson Financial Planning, where a couple of our fellow certified financial fiduciaries took over the program last week. Rob Field and Garrett Fields, they had a great opportunity to run the show, and they did, and they, for the first time that I hadn't been sitting there, did a pretty decent job. So we want to certainly thank them for their efforts last week on taking the program and running with it. I did listen to it. Sounds like they had some interesting conversations about the markets and emotions. Boy, that's certainly a timely topic. So we thank them for hosting the show last week. I, of course, was away. I don't know if they mentioned that. I don't think they did specifically what I was up to, but I was celebrating some dual March birthdays, albeit a little late. But my oldest turned 21. My middle one turned 19 over the course of the past 30 days. So we had an opportunity to kind of get together with them and spend a little bit of time celebrating their birthdays, because you don't get to see them very much because one's in Alabama and the other one's in Virginia. So anyway, it's off celebrating birthdays. So now, today, as you know, we talk on this program a bit about the stock market. And today I thought, though, rather than kind of talk about the stock market, I think it would be important to talk a little bit about the bond market, particularly as folks are getting those quarterly statements for the first quarter. You may be looking at them and saying, wait a minute, the stock funds and the bond funds are basically down the same amount in those first 3 months. What's going on with that? Well, Rob and Garrett talked a little bit about that last week on the program. Remember the inverse correlation that exists with bonds. As interest rates go up, bond prices go down. So let's just use an example on that for just a second to maybe help folks understand that. So if I buy a bond, it's $1,000 face, it's paying a coupon of 3%, right? All right, so then interest rates go up to 5%. Well, wait a minute. I'm stuck holding this bond paying 3%. I don't like that. It's not worth as much to me. See, that's where it comes in. The value goes down. That bond at 3%, not worth as much to me as what it used to be, because I could go in and go out and get a new bond, and that new bond is paying 5%. So then the value of that bond that was at 3% now goes down in value. So hopefully that helps to kind of paint the picture a little bit better in terms of how that inverse relationship works. I think on the program last week, Garrett was talking about the fact that it's that money is worth, if you're getting more for that money now, then that money that you had is simply worth less because you're not getting as much as what you're getting now. So important to understand that distinction. Also important to help to bring some perspective to it when you're looking at your statements and saying, oh my goodness, these bond funds all down as much as the stock funds. And in some cases, some of the bond funds are actually down more than some of the pure equity funds that are out there. And that decline has been particularly dramatic in the first quarter of this year. And by that we mean, if you think of interest rates, I think this may be one of the fastest change in interest rates that we've seen in our lifetimes. I'll give you the numbers. At the beginning of the year, you could basically borrow 30-year money, right? Traditional mortgage at 3%. Today, that is now pushing close to 5%. Folks, that's a huge swing within a very, very short period of time. And if you really take a look at the 90 days in the first quarter of the year, you could probably pick like a 45-day window towards the back part of that quarter where you saw that move, or the majority of that move, happen within just a 45-day window. That's how quick those interest rates move up. Now, interestingly, it's a 2% jump, 3 to 5 almost, in terms of that longer term money. But the Fed's only raised rates 1/4 of a point. I mean, that's the crazy thing of how quick those interest rates have gone up for just a minimal increase in interest rates, in fact, by the Federal Reserve. Now, Federal Reserve has obviously come on record and said, hey, we're going to do a lot of these increases over the course of the rest of this year. So some of that instantaneously getting priced into the bond market. But when you go from 3 to 5, it's a pretty significant decline in terms of those underlying prices and those underlying the value of those bonds. So that's what's happening on just a single 1/4 point increase by the Federal Reserve. Big changes in terms of the underlying interest rates, and the era of easy money, if you missed it, you missed it, because that period of time is behind us. And I think that era of easy money certainly coming to a close, particularly over what has happened just in the first quarter of this year. So how do you deal with that? How do you avoid that? Well, probably means you're holding more cash, or you should be, rather than loading up on the bond side of things. If you are on the bond side of things, well, certainly you don't go longer term on that. Longer term bonds are going to be much more susceptible to those interest rate increases. So you keep on the shorter term. Remember the analogy, right? If I've got $1,000 note, $1,000 bond, and I was getting 3%, and now all of a sudden those rates have gone up to 5%, well, then that bond is going to be worth much, much less, because I can get a better return, a better interest rate in that new money. But at the end of the day, if the bond itself is a shorter term bond, then that reduces that risk, right? If that $1,000 bond was coming due next week or next month, then you wouldn't be quite as troubled about that pricing change as much. So that's why you stay more on the shorter term side of things. The reality is that in today's world, high inflation, rising interest rates, it's hard to get anything. Investors clearly have a conundrum to work through in terms of these interest rates. When we get back, we're going to give you an interesting statistic, though, of how much money is still flowing in to the cash side of thing. And then we'll shift gears and talk about another conundrum. That's the IRS. Coming up next year on Dollars and Cents. Talking about the conundrum that investors face as we go into a period of rising interest rates. Certainly seen that play out in those first quarter statements. If you're looking closely, a lot of the bond funds went down as much as the stock funds in the first quarter of the year. So certainly not something that is typical, that is for sure, but something that unfortunately I think investors are having to grapple with, particularly as we go through rising interest rates. Just within a very short period of time, we saw 30-year money, 30-year mortgage type rates go from basically 3 to almost 5 within basically a 45-day period of time. So pretty dramatic shift, which then ultimately undermines the value of the bonds. What do investors do? Well, as we were talking about, it's clearly one of the hardest conundrums out there, because that portion of your portfolio, that portion of your investments, should be positioned in a safe manner, right? I mean, it's important to have a portion of the portfolio like that so you can use that when the other things, headlines, stock markets, things like that, aren't behaving as well. So important to keep that money more on a little bit higher cash position, or certainly more on the shorter term side of things when you're thinking about bonds. The reality is there's still a lot of cash floating around out there. If you look at the latest statistic, money market funds in the US have increased a total of nearly $800 billion over the previous 24 months. So if you think of the previous 24 months, that's the entire period of time during the pandemic. So a lot of that money probably getting accumulated because people aren't able to go out and spend it, number one. And number two, of course, government was throwing a bunch of cash out the back door on people in the form of stimulus checks, child tax credits, things like that. If you think of it in terms of a per day, it's over $1 billion per day over the course of the past 2 years. So $1 billion every day going back over the past 2 years that money market funds have had an inflow of over $1 billion a day over the past 24 months. It's pretty dramatic when you stop and think about that, because clearly money market funds not really paying anything at all. In contrast, the market gain of about 60% over that same 2-year period of time. So a good sort of underscore, if you will, on why sometimes when you think the market's going to do X, it doesn't, it does Z. So certainly when you look at those numbers, but a lot of folks still have a lot of cash, still putting a lot into the money market side of things. So we talked about that conundrum. Well, let's shift gears to the other conundrum that is happening out there, and that is your tax return. Hopefully, you know that the date is a week from tomorrow, right? I mean, it's April 18th. We're back in terms of the mid-April deadline for filing your taxes. The first year in the last 3 years where the traditional deadline is holding. No exceptions to it. Doesn't matter the millions and millions of returns that the IRS is behind. It's the date you, the taxpayer, must observe the deadline. IRS, deadline doesn't apply to them. And I know that because I just got my refund check. So if you've been listening to the program, you know that I haven't gotten my refund, and I have been waiting now about 6 months for it. Finally came in the mail. So anyway, so much for deadlines from the IRS's perspective. The traditional deadlines, unfortunately, now apply to taxpayers, which means that got to get them done or file an extension. Now, here's the caveat. If you file an extension, understand that you still have to kind of think about, wait a minute, do I owe or am I getting a refund back? If you're getting a refund back, you don't have anything to worry about. But if you owe, you probably want to put some money in to cover that potential bill, because if you don't, you're going to get hit with penalties and interest, which are going to kind of really add up. The IRS likes to make sure that it's collected all of its money by mid-April. And so make sure that you at least, if you are getting that extension, make sure you at least try and calculate out what that tax liability is. Actually spent a bit of yesterday trying to figure that out on a personal basis, because I don't like paying penalties. I don't like paying extra interest if that can be avoided. So make sure if you do file that extension that you may run that calculation and you run those numbers. But one of the things also this year, again, tax filing deadline is a week from Monday. Remember, markets and most banking institutions are closed on Friday. Friday is Good Friday. Of course, next Sunday is Easter. So what that means is that a lot of those financial institutions are going to be closed on Friday, and then the tax filing deadline files on the Monday. So bottom line is, if you need money to cover that tax bill, probably want to make some arrangements on that at the beginning of this week rather than at the end, because you're going to find that nothing's working on Friday. Stock markets are closed, banks closed, things like that. So make sure that you wind up taking a look at that in the beginning of this week rather than later, because Friday is going to be the holiday. So anyway, about a month ago on the program, we had fellow certified financial fiduciary and CPA at Nelson Financial Planning, one of our cohorts and partners. Kristen Cayley was on the program talking about the do's and don'ts of this tax year, one of which that we talked about at length was tracking down your stimulus check. Did you get it or not? We're already seeing, okay, so here's the conundrum for taxpayers. We are already seeing the IRS reaching back out to folks that tried to claim the stimulus check on their tax return, and because they didn't get it or it got lost in the mail or whatever the case may be, and disallowing it right out of the gate. And this is happening within a very, very short period of time. It takes them 6 months to deliver a refund, but it's 30 days turnaround for them to say, wait a minute, we don't believe you that you didn't get the check, because we are saying that we sent you the stimulus check, we the IRS. I'm sorry, our information trumps yours, so we are not allowing you to try and claim it. Here's the example. So for this particular individual, we filed their return on February the 28th. In that, we claimed, as you're allowed to do, the stimulus check because this particular individual never got it, didn't come into his bank. Okay, fine. Maybe it was in the mail and it got lost, or maybe they sent him a debit card and it got thrown away. Whatever the case may be, he did not take possession of the $1,400, nor did his wife. So it was like a $2,800 difference, which is that's significant money. So what you do, or what you're allowed to do, is on the tax return, you claim the recovery credit. Okay, hey, I didn't get my check, I'm claiming it on my tax return, so included in as part of my tax payments for the calendar year 2021. So in this particular case, that's exactly what we did, except for the crazy thing is that within 30 days, despite the IRS being 24 million returns behind, they immediately sent him a letter, a CP11 notice, that basically said, we are disregarding what you put on your return as it relates to the stimulus check. Completely disregarding, saying, no, you're not going to be able to do that. Our information, our records say that you got that check and you have to prove, I guess, the negative. How do you prove that I didn't get something, right? I mean, that's the crazy thing about how these stimulus checks are working, especially when you're trying to true it up on your tax return and say, hey, wait a minute, I never actually got it. I didn't, and it's not an insignificant amount of money at $2,800 for a couple. But the IRS, whatever they say, goes. So in this particular case, not only did they say, you're not going to get it because our records show that you got the check, they added a $39 penalty as well. So not only did they take it away, but they also kind of, kicked you in the pants a little bit by adding in a penalty. So bottom line, unfortunately on this, folks, there is no great solution, no great answer, and certainly no easy path of recourse for taxpayers who the IRS says, hey, you got the check. You say, I didn't get it. The IRS basically says, tough, unfortunately. So with that, we will shift gears, take a break, and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to the program. This course is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of radio stations throughout Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So my name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So before the break, we were talking a little bit about some of the options that the state of Florida employees have. And so we thought it would be a good opportunity to talk a little bit more about those, particularly with some of the correspondence that state employees are receiving once they retire. You know, a few years ago, we created a booklet to provide folks with an opportunity to get sort of the range of information that exists as it relates to your retirement, specifically for a Florida retiree, someone who's worked for the state of Florida. There's a lot of different nuances in terms of the options that you have when you leave the state, or for that matter, while you are working for the state, right? You've got the pension plan, you've got the investment plan, you've got drop, you've got deferred comp. All of those have very different aspects to them. And so we thought it would be a good idea to sort of sit down and write this booklet that talked a lot about those different types of options that are available to you as a state employee, and sort of describe and contrast sort of the differences between them, the pros and cons, if you will, of each document. Well, obviously we did that booklet several years ago. We've updated it along the way, and so we have just recently re-updated that booklet, now in its 4th edition. If you would like to get a copy of the full booklet, well, then you can simply call the office this week, 407-629-6477, and we'll be happy to mail you out a nice little bound copy. If you're watching us on YouTube, here it is right here, little bound copy of exactly what we have in terms of that booklet. Or if you'd like, we also have it available for download on our website at nelsonfinancialplanning.com. So either way, check it out. It's got a lot of good information in there, plus a lot of the changes as well that have really rippled through the options for state retirees. Things like there's no more COLA, right? No more cost of living benefit if you are on the pension side of things. As an employee, you have to pay in 3% of your salary on every paycheck. You have to pay in 3% of your salary, and then the vesting period, the time in which you actually accrue a benefit, has been extended, particularly under the pension plan. So anyway, created the booklet, recently updated it. Certainly a lot of different chapters in there, and the one that we've added most recently has to deal with the one of the benefits that sort of gets forgotten, which is the health insurance, the subsidy. Certainly got some chapters in there about the uniqueness of 457 deferred comp, some of the big changes, the litany of changes as we talk about it in this booklet since 2008. So the latest edition that we just finished, the 4th edition, if you will, has a new chapter on sort of the timing and the sequencing, if you will, of what that's important for investment plan members. So if you're retiring from the state and you're in the investment plan, there's a very specific set of timing and sequencing that you've got to get right in terms of getting your eligibility for your health insurance subsidy, in terms of getting access to your money, in terms of getting the ability to generate out income from said dollars. So that's the newest chapter in the booklet that talks a lot in detail about the sequencing and why that matters for folks in the investment plan. So anyway, if you'd like your hard copy of it, here it is here for the YouTube audience. Just give the office a call and we'll certainly put one in the mail to you. Or if you'd like your copy right away, you can go to the website, Nelson Financial Planning, and download that. So speaking of investment plan and Florida retirement system employees, if you are retiring today under the investment plan, you are getting no less than a 10-page promotion for annuities. Not just any annuities, but annuities from MetLife. I wonder how much they paid the state of Florida to get this kind of access to people right at that point of decision. I mean, you talk about invaluable information from a marketing perspective. Just think of that, right? If you're in the business of gathering assets, don't you want to know who is at that point of decision, that point of retirement where they're going to be making a decision as to what to do with their assets? Well, lo and behold, the state, well, again, I don't know how much money they're making from the annuity people, but they are now sending out 10 pages of information that talks about information on a lifetime income. You know, we were able to get a copy of this because one of the folks that we work with is in the process of retiring, and he happens to be in the investment plan. So he dropped off these 10 wonderful pages that he got in the mail from the Florida Retirement System. And this is on Florida Retirement System letterhead. It is on, it's like a communication direct from the Florida Retirement System. Now, remember, it's going to an investment plan member. So if you're in the investment plan with the state, you at some point made the decision to switch from the pension to the investment plan. And so what that means is that you gave up sort of that guaranteed monthly check a month under the pension to shift over to, okay, I want to control all of those dollars that are associated with generating out said monthly check that under the pension, I wouldn't have any ability to ultimately touch those dollars. I would just be using that to generate out income based upon whatever option I pick under the pension plan, versus the investment plan where I now have a chunk of money that I am free to use and utilize to generate my own income. So here's what the letter says. Information on lifetime income. Our records indicate you recently terminated employment. I mean, again, this is, phenomenal timing in terms of marketing. This is priceless if you're in the business of trying to gather assets, much like the folks at the annuity provider MetLife are doing, right? I mean, that's their business. We want to make you aware, because, there's no way that you'll ever be aware of anything unless we, the state of Florida, makes you aware of this, of the benefits of converting some or all of your investment plan balance into lifetime income, also known as annuity. Well, it was nice of them to tell them exactly what it was. This option is being provided to you by MetLife on behalf of the FRS. Isn't that nice? That's great. So, first of all, why would you even consider an annuity for your investment plan balance? Because that's kind of what you gave up when you switched from the pension. So if you really wanted the guarantee, why'd you switch in the first place? I mean, it doesn't make any sense, right? The letter continues. Why this is important to you? Well, lifetime income options help to manage risk and guarantees that you do not outlive your savings in retirement. Okay, wait a minute. What is that thing? There's a little footnote next to the word guarantee. Footnote 1 after the word guarantee. So where is footnote 1? Where is footnote 1? Well, it's not on page 1. It's not on page 2. Oh, there's footnote 1. All guarantees are based on the claims paying ability and financial strength of Metropolitan Life Insurance Company. Okay, so wait a minute. I choose the investment plan over the pension, and then I'm told you should do an annuity with MetLife. Okay, hold on. There's another thought there, but we got to go to a break. So stay tuned through the break as we digest this fabulous correspondence from the Florida Retirement System to recent retirees. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. We are back and talking about the 10 pages of propaganda that retirees from the state of Florida who happen to have gone with the investment plan option are getting inundated with, courtesy of their former employer, the state of Florida, the Florida Retirement System, sending out 10 pages of documentation giving recent retirees information on lifetime income. We were following up on one of the sentences in this fabulous little piece of propaganda the sentence that says lifetime income options help to manage risks and guarantees. There's a little footnote on that word. You gotta go 2 pages over to find it, but we, able to find it. And it says all guarantees based upon the claims paying ability of Metropolitan Life Insurance Company, otherwise known as MetLife. Well, the crazy thing about this is, why would I give up to the extent I made the decision to move over to the investment plan, right? Then there obviously was some factors that go into that. And one of which is, okay, well, I want to control the money. And I think that ultimately over time with the right investment strategy, okay, I can successfully generate out some income. And then at the end of the day, I can pass that on to the next generation. That's usually one of the biggest reasons why people move over into the investment plan. You don't move over to the investment plan to pick up a guarantee that's manufactured by a life insurance company, because the guarantee you gave up was far more valuable, right? States don't go out of business. Sometimes insurance companies do. So why would you give up the guarantee offered by the state under the pension plan only to then get this marketing material that says, oh, well, you can go in and get an annuity and life will be grand? Well, the problem is that just doesn't make any sense. If you moved over to the investment plan, chances are, hopefully, you made an informed decision as to why you gave up that guarantee that comes under the pension plan in the first place. Because at the end of the day, there's really the same kind of options in terms of the payouts and things like that, right? You can get a lifetime income, you can get a lifetime income for 2, that's option 3 under the pension plan. Lifetime income for you is option 1 under the pension plan. A lifetime income with guarantee period, that's option 2. So it's offering the same options, except you're in the investment plan for a reason. Here's the other thing that's kind of fascinating if you kind of read through all 10 pages of it. At no point did they tell you what your effective rate of return would be on said fixed annuity. And let me tell you something, they don't tell you it, but it is well below 2% in terms of when you run the numbers on what this ultimately generates for a return. Now, how is that going to do? How is that return going to work when inflation, hopefully inflation stops running at 7 or 8%. We think that even when that does stop and it kind of gets down to a more normal, level, it's still going to be a higher normal than what we're used to over the past 20 years. Think 3, 4, maybe 5% in terms of inflation going forward. Well, if my annuity is at 2%, because again, these projections are run based upon prevailing interest rates still very, very low, unless you're trying to buy a house and then they've jumped up pretty dramatically. But prevailing interest rates, the kinds of interest rates that the insurance company uses to calculate out these benefits, those didn't move that much. That wouldn't be in there. And that wouldn't be an incentive on the insurance company's part to move the needle that much on those types of calculations that they make when they generate out these payments. So at the end of the day, it's a 2% or less effective return. That's not even staying ahead of inflation. But nowhere in the 10 pages did they actually give you a number. A lot of Q&A. What's a fixed income annuity? What's the benefits of a fixed income annuity? What are the risks? What are the payment options? What happens if I die before the amount? A lot of Q&A. 7 pages of the Q&A. It's 3 pages of the propaganda, and then it's 7 pages of Q&A. But at no point, at any place in the document, do they actually talk about rate of return and what that effectively is going to be. So what that means is stay clear of this one, folks. It is fascinating from whence it is coming, right? Because it's coming from the state of Florida. The Florida retirement system sending out correspondence to people right at that point of retiring and ultimately trying to capture business on behalf of MetLife. I'm just fascinated by the relationship or the contractual agreement, whatever it is that exists between the state of Florida and MetLife, that literally you got the state of Florida hawking for MetLife. There's no other way to say it. State of Florida operating as an insurance agent on behalf of MetLife. That's what these 10 pages is all about. Isn't that crazy? I certainly hope that the state is using that money wisely, maybe putting that towards some schools or some bridges or whatever the case may be. But hopefully the state is using that money wisely, that it's generating as a result of this correspondence. And I certainly hope the state is charging a hefty price as well, because you don't get much better in terms of ultimate marketing as a business to be able to approach somebody specifically that has that need or is at the crossroads of making that decision, and ultimately you're able to approach them with another option right when they're making that decision. Fascinating stuff. I really will be curious if it ever comes out exactly how much the state is making on this deal as it sits and it hawks annuities for the folks at MetLife. Fascinating stuff indeed. Anyway, back to what we talked about earlier in the program. Obviously, we have a booklet, we have a pamphlet that describes all of the different options without really advocating one over the other. We think it's more important to just have good information about what your options are and what the pros and the cons are in terms of all of those different options that are available to you, because at the end of the day, if you're going to make an informed decision, make sure you have all the information. So the booklet available on the website, also the latest edition, which also includes a chapter about why the sequencing matters for folks like this that are in the investment plan with the state of Florida, why the sequencing and the timing of all of that matters in terms of how you space it out and what days you want to do what on in order to make sure that you're maximizing your benefits and your accessibility. So, interested in the booklet, just call the office this week. We'll be happy to send you out a printed copy. If you want to look at it this afternoon, or anytime, you can always go to the website, Nelson Financial Planning, and download the booklet for free there as well. So anyway, we're going to wrap it on up and get on out of here. Thanks for listening to the program. This has been Dollars and Cents with your host, Joel Garrison, Nelson Financial Planning.